Good afternoon. Peter Klein, Chief Investment Officer, co-founder, Align Wealth, with you on this May 11th, 2022, after market close. Felt that given the market conditions and the volatility that we've witnessed over the last few weeks, that it was apropos for a quick video flash to give you some sense on what we're seeing and what you may likely expect to see going forward, and how best to navigate those twists and turns. Bottom line, folks, at Align Wealth, clients come first and second and third. We care for our people, we care for our clients, and this is why we're being proactive in making sure you understand what we're seeing going forward. So allow me to share my screen, and we'll give you a quick briefing on going and the strategy going forward. Okay, here we go. Okay, so first thing I want to spend some time talking about is what I've called, maybe this will work, maybe they'll be talking about it on CNBC tomorrow, the spring swing. I don't know, just thought I'd come up with something. That's my sort of lame attempt at a name for this market action. Like a pendulum, markets will always go from extremes, right? They'll go too high, as we've seen many times in the past, and they'll go too low. And I'm not sure we're there on the low side just yet, but obviously it's been a tough couple of days. So it's not our objective as clients, as investors, to always try to capture the bottom and capture the top. Our goal is to reduce exposures when things are heady and things are crazed up on top, and to increase exposures to markets and equities and growth when things are down. So again, that's sort of what I want you to think about. Things were way up crazily in some way, shape, or form. You pull back, you raise cash. When things are going down, the opposite occurs. You must look to put opportunities to work at lower levels. You're never going to call bottom, so don't try, but you feather in, you leg in, you put a little bit of capital to work. We'll get there. I'll give you a strategy. Number two, economically, very interesting setup, right, folks? So we've got this full employment, consumer strong consumer balance sheet. We also have a persistent inflation, the I word. And as you know, we've been talking about inflation early on. We were talking about it before pretty much a lot of folks were, and we were saying that we believed it was going to be a less transitory and more pernicious, and I guess we got that one correct. And so you have a Fed, because of this inflation setup, that's likely behind the curve. That means something, right? Because they're going to have to raise interest rates for every. We'll see. We'll see the effect of this market action and the effect of the interest rates so far. Will that slow the economy down to a point where inflation comes down? We had inflation news today. It was a little off, nothing dramatic. We'll see how it plays out in the coming months. Number three, as I mentioned, we already had a pretty substantial correction in the stock market. You'll see it from a perspective of the large indices. But the Russell 1000 down 17, the average stock is down 17. The average stock in the NASDAQ is down about 25%. And the NASDAQ itself down about the same, 25, 26, the Dow down about 12. But if you look deep into those indices, you'll see carnage, especially in the high tech, high multiple area, of which we've had some concerns about early on. Those companies, a lot of those stocks have been hit very hard. So that tells you that the stealth bear market, the stealth crash-like market, has already taken a lot of air out of the market in certain spots. Maybe that is going to give the Fed some cover as well, right? We'll see. And again, we've been kind of expecting this, and you go back and listen to some of the videos and some of the writing that we put out over the last year. This is not something that should surprise any of you. I mean, it's never fun. It's always aggravating, and in many cases opportunistic, right? So, but clearly, we've been on record as stating that we felt the market was overcooked. There was a lot of speculative froth out there. Valuations were very high. We've spoken about all of this, and this is not a surprise, right? And so that is important. And that's why we've overweighted cash to some perspective. Not every client is different. Every investment and portfolio and objectives are different. But having, going from the hated cash is trash to now, oh boy, I'm thankful I've got it. And it's not only because it serves as a ballast to a portfolio, right? Protecting it, not going down, giving you that balance that bonds used to give us that no longer can give us, right? But in addition to being a ballast, cash is serving as a font of opportunity from which we can take and allocate at lows. You're never going to call that low, but clearly as markets go down, we could feather in and we could leg in and find those opportunities. And we have a robust buy list of very well-researched, high conviction ideas. We'll get to it. Some of those opportunities are playbook, as you well know, 4 I's and 1 V, infrastructure, international, which is more of a back burner, but still some really good opportunities. But clearly with the war, some back burner there. Inflation-centric front burner, right? Innovation, always want to have some innovative companies in your portfolio, but you don't want to pay up for them. So you want to be careful at what the price you pay. And of course, value. We want that value. Oh, and let's not forget water, right? Okay. So investing is much like farming. Stay with me on this. We plant the seeds, we water the soil, we study the weather, we steward the crops, we care for them as we care for our clients, right? And we wait. Patience, we wait. And for the fruits of our work to yield results. Folks, today we're in the seed planting phase. Let's not miss this opportunity. Quick couple of slides on market conditions. There is a bit of a regime change. We're seeing interest rates go up for the first time in 40 years. 1982 to 2022, 21, straight down on bond market, straight down on interest rates, straight up on bond market. It's changed, a lot, right? We have a lot of consumer activity, stock market valuations, bond market. Obviously, it was the greatest tailwind for investments of all time. It's changed, right? We're in a different paradigm. Doesn't mean it's over. It means things have changed, and you have to change your playbook accordingly. Okay, and so we've seen that, and in this slide here, you'll see a couple other sort of these paradigm shifts. I thought this was kind of interesting and something to sort of look at. Next, we have this idea that corrections and bear markets are, well, frankly, somewhat normal. I mean, -10 to -20, the sort of typical non-bear market correction drawdown, 73% of them of drawdowns more than 10%, right? And you got this, larger. This is the bear market drawdown. That's 17%. So most of the time you're in this zone. They average about 7 months. It happens every 3 years. The average is about 14. We're beyond that now. So we're in this phase here. We'll see. I don't think we're going to go too deep here. We'll touch it. We'll see. But to have the plan at the ready is our job, is to be expecting and waiting to begin to put capital to work opportunistically and carefully. This is a slide that shows you the what volatility looks like year after year, and you can see here how there's been a fair amount of intra-year drawdowns, on average about 10%. This should not be surprising. It's only surprising because it's happening now, but it always happens. It's part of the game. It's part of investing. It's part of life. You're going to have the ups and downs. How you manage that, how we manage it for you, and how we manage it together is the key. Now, this idea of being all in and all out, right? trying to sort of time the market. Doesn't work. Doesn't work. This is a really cool slide that shows you out of 10,000 trading days, if you miss just 30 of them, a small fraction of the 10,000, right? It's a 90% reduction to what the total investment would be. Now, maybe you don't want to be always fully invested. I would never suggest that. Most of the time, we're going to have some cash, right? Now we have a bit more cash, but you don't want to go all in and all out. That's when mistakes happen. You want to have your sort of, your fundamental piece of the portfolio, and then you have your tactical piece where you're looking for opportunities. And again, that pendulum where it goes too high, it takes them off the table. And we've done that. If anything, we've been early on that. Okay? Let's not miss the backside. Let's not miss the opportunity. And this is what the opportunity is, folks. The eighth wonder of the world, right? Compounding. That's our goal. That's what we do. We compound wealth over time within our clients' objectives and their constraints, right? That's our mandate. And to do that, you've got to be invested, but you've got to do it mindfully. And that means when that pendulum was too high, we took some off the table, and now it's swinging back down. It's time to sort of look at planting those seeds, right? So game plan. Expect continued volatility. I don't suspect this is over. I think we'll have some ups and downs along the way. We're getting close to sort of that, maybe that seventh inning stretch kind of thing. I don't think it goes to extra innings. We'll see. Embrace volatility. It's what we've been expecting, what we've been waiting for. That's why we had the capital on the sidelines for this type of opportunity. Allocate capital slowly, carefully, responsibly. We're not gunslingers, folks. That's not what we do here at Aligned Wealth. We manage capital responsibly for our clients in a fiduciary-centric manner, bottom line. So we're going to do that. But we also want to keep an eye on opportunity, right? And we want to be occasionally bold, a little bit bold when we see opportunities, okay? And finally, we've maintained investments in funds and companies that we see as opportunities. We've done a lot of research on these. We do a lot of research, okay? And now we expect a legging in process, right? So you buy a little, you wait for those down days, you don't chase. These are the things that you do. You're not going to call a bottom. Don't even try. But by legging in, and you turn around, the old adage is true. You make most of your money in bear markets. You just don't realize it yet, right? You're buying low, and then you wake up a year and a half, 2 years later, oh boy, that's how you do it. Not easy, it's emotional, but that's why you have partners like Aligned Wealth to help you through it. I hope this has been helpful. We really are here for you. Give us a call if you need any further discussions on these matters, a strategy call, an update on your portfolio. I'm happy to do it. And at Aligned Wealth, we're here to serve. And thank you for your continued vote of confidence. Thank you.